and I thought this game is easy. With time, I learned this game is anything but easy. In order to be an effective investor, one has to bet against the consensus and be right.
Ray Dalio expected a massive depression in the global economy, so he acted accordingly and bet against the consensus that expected a bull market. Ray Dalio was wrong, and over the next 18 years, the market experienced one of the most extensive bull runs in history. After such a massive financial beating, he almost lost his entire hedge fund. Ray saw himself laying off loyal employees one by one to cut costs, and he even asked his family for money. It was a great humbling experience. Today, he is at the top as a billionaire with a lot of wisdom to describe 10 investors' worst mistakes. But first, subscribe to Market Magnates and click the notification bell to not miss any of our following videos. Number 1. Better and cheaper have distinct histories. Ray Dalio observed one of the most common mistakes made by each client and most investors, and it could certainly help you a lot. When a stock rises in price for a long time, that doesn't automatically mean it's a good buy. You don't have to chase it to get it in your portfolio ASAP. Ray proposes an essential change in that perception, a change that could save you a lot of headaches and money. A stock that has done well lately is not always a better investment. Quite the contrary, it is expensive, and a stock that has gone down in price lately is not the worst. It is cheap. That shift in mindset can help you see incredible opportunities that would otherwise be out of reach. And when it comes to seizing an opportunity and making $1 billion out of a stock nobody saw coming, Ray Dalio is an expert. The outcome? A couple of weeks ago, Ray Dalio shorted his positions, betting against several European companies. He doubled his money, winning billions in the process, something that would never happen if he followed everybody else's trend. Number 2. Money is garbage. Many people make the number 1 mistake about investments, spending too much time choosing while their money keeps quiet in a bank account or a mattress. For such a legendary investor that knows the power of investing, cash is trash. And keeping your money isolated from the millions of financial products you have at your disposal can seriously damage your purchasing power and overall capacity for economic growth. For Ray Dalio, cash is not a safe investment, as most people think. It's easy for many people to think it is, since cash has very low volatility. Yet, slowly over time, holding cash taxes you 2% each year. So it's always the worst investment, since no matter what you do or how much you can gather, it will lose 2% without factoring inflation. According to several estimates, worldwide inflation in 2022 will reach a rate of 7.5%. Tax it by 2%, and you are looking at a 10% loss on purchasing power every year your money stays still. Number 3. You obey the crowd. Following the same example, if a stock is rising fast and there is a lot of money coming in, then one of the best things you can do is get in or out on your own terms. Without being influenced by the noise around you that could cloud wise investment decisions, Ray Dalio knows when it comes to finding great opportunities, you have to be creative and follow your expertise. If you are not, you will end up buying the same things everybody else buys, and that's a risky move. Thinking outside the box can help you identify opportunities that few others see. You can see how many investments and stocks have failed after being hyped for months. That is one of the golden rules in the market. When there is a lot of noise around a stock, it's because it's reaching its peak, and it's time to sell and save your gains. When there is an immense quota of silence around an unhyped stock, you can get ahead, buy first, and ride the wave nobody saw coming, as Ray Dalio did countless times. Number 4. Keeping all of your money in the same location. The market is volatile, and as a wise investor, Ray Dalio always has a plan B to defend against any emergency. For over half a century, this legendary investor has taken several risks and analyzed the depth of the market that could crash in any given year. Dalio has long understood the importance of diversifying your assets and seeking refuge in volatile markets. Gold is that refuge for this astute investor. Gold is the asset that will keep going even if the monetary system breaks down and money is redefined. Having your money in only one financial instrument or currency is too risky. This billionaire man knows it. That's why he transforms his money into many different assets, such as gold and crypto. Ray always recommends being humble and expecting the worst, which includes buying Bitcoin, gold, and diversifying your portfolio for a well-rounded safety net. According to Ray, if the world we know crumbles, you'll be safe by diversifying. Number 5. Price comparison without context. One golden rule for Ray Dalio is that every price has a history determined by a particular moment. Look at the cycles before you buy stock, whether you're buying before a historical bear market or a massive bull run. Ray Dalio doesn't know the future, but he can read the signs that lead you to believe what you are getting into. There's one thing he has learned over the years. It is that cycles repeat themselves. The founder of the world's largest hedge fund knows a thing or two about cycles, especially when he's been investing for over 50 years. He says that before you learn about complex trading strategies, you must figure out a simple lesson from history. Cycles repeat themselves. Assume you can see warning signs before a bubble bursts, and you lose all the assets you were given. In that case, you can avoid the 99% mistake of most investors, going into a trade without having a clue of the historical context surrounding its price. Ray Dalio points out that in the 10 years following the collapse of Lehman Brothers, many people were so lost that they stayed out waiting for the right opportunity. The S&P 500 increased by 130% in 1 decade. Number 6. Purchasing emotions. The quickest way of losing money is to buy emotions, not stocks. Ray Dalio knows this pretty well when he says that you should pay attention to what cycle you are in and don't pick stocks in your portfolio just because everybody is buying. For Ray, that's a common beginner mistake. And if you get a colder treatment for your decisions, it's easy to distinguish when you buy out of fear or greed. The market tends to be more expensive when there is a lot of greed. Expensive markets have a lot of confidence and are very cocky. That's why there are wiped out accounts during a market crash. Many use leverage, and at the first sign of trouble, they are the ones that suffer the most. Many buy with confidence at the peak of it all and sell shocked, fearing it could fall further when it all crumbles, especially buying high and selling low. If you learn about the different market cycles, you can avoid losing a lot of money and having your accounts wiped out. Number 7. Following the herd. Investing is a process, so once you develop that ability to know what cycle you are in, then you can decide what risks you can take. For Ray Dalio, the first step to becoming a great investor is understanding the cycle and being counter-cyclical. Following the crowd won't get you ahead of the pack. There is an attitude and vision Ray Dalio has honed over the years, being counterintuitive, which means buying when everybody is selling and selling when everybody is buying. That's an essential skill to learn to leave behind all those bad trades. Those are the alarming trends where you follow the crowd for fear of missing out and buying whatever stock starts to skyrocket out of hype. By analyzing the market's timing, you can get a perfect picture of where you are. Number 8. Always expecting to win. You can't expect to win every time you invest to be a long-term investor that thrives through several market cycles. Many people have said that Ray Dalio takes inspiration from Warren Buffett and Paul Tudor, yet the truth is very different. A lot was figured out by himself since, from his early days as a young investor, the first teacher of Ray Dalio was his experience. According to Ray, he learns through experience. Even though he is among the club of legendary investors and they meet each other daily, he had to learn everything by himself. Ray's best learning experiences were from mistakes, taking his time to pause and reflect on them. And he explains it with a simple principle. Pain plus reflection equals progress. If you reflect on your pain, you will know the cause, and you can choose a different path next time. It works for the market and is also a good piece of life advice. So the next time you feel anxious before buying a stock, think it through so you don't make the same mistake twice. Number 9. You don't know where you are standing. Before investing, the most important thing you can do is take a step back and analyze the overall situation. The whole economic scene can change with a devastating conflict on the other side of the world. Volatility can spike from one moment to the next while you're invested in a stock that you thought was the most secure. Ray Dalio knows how the market can give you a lot of surprises. He always says that if you encode a situation, you can prepare well for what's coming. Ray has seen over 50 years of global investing. And one of the most successful steps he took was to avoid the mistake of feeling lost. Ray decided to look at 500 years of history to find patterns that he could use to make money. He found that economic swings mostly lasted a decade, and then social change and global conflict would follow. Those trends would help him identify the big picture. As Ray Dalio states before buying, if you worry, you don't have to worry. If you don't worry, you should worry. The safer the bet feels, the more dangerous it is for Ray. And the more you know about its history, the more prepared you are. Number 10. Investing in a friend's recommendation. The worst thing you can do is follow a friend's advice by buying stocks with your hard-earned money because of a friend's tip. You are already lost before you make the investment and are entering an aggressive market with a blindfold on. The risk you assume when you buy is not just a word, it is a real threat. Some investors love risk and some hate it. But it doesn't matter what kind of investor you are. Risk should be the main focus of your analysis. For Ray Dalio, it's a recipe for disaster if you get into an investment without knowing what you are getting yourself into, since the risk grows exponentially when you trade in an unknown sector or industry. What's the best investment advice you've ever heard?